Starbucks and McDonald's are facing headwinds that's decreasing revenue growth. Still, the companies have over 30,000 locations worldwide and have generated brand loyalty for decades in serving them well. But which one of these two stocks is the better buy for long-term investors? I'm going to answer that in this video, comparing these two on revenue, on operating profit, on return on invested capital, and valuation to determine which one I think is the better buy for long-term investors. Let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So like I highlighted in the beginning of the video, revenue has turned downward for each of these two. Still, in the most recent quarter, McDonald's increased revenue by over 2%, but Starbucks revenue declined by more than 3%. The more exciting thing about Starbucks is that it was able to snatch CEO Brian Niccol from Chipotle. And the CEO had done such an incredible job at Chipotle that Starbucks was paying a large price to get the CEO to come join Starbucks. Starbucks, ever since founder and CEO Howard Schultz had stepped back, had found it difficult to find a leader that could steer the company in the right direction. So with Brian Niccol, I think the company hit the jackpot. Brian Niccol is one of the better CEOs in this category. In fact, you could argue the best CEO in this category. So that's going to be, in my opinion, a tailwind to the company going forward. McDonald's, meanwhile, the big tailwind for McDonald's is food delivery. Up until, let's say, 5 years ago, in order to have McDonald's, you had to go to one of their locations. You had to either go to a drive-through or go inside. And that limited the occasions where you can have McDonald's. With food delivery, it now expands the reach of every single McDonald's location worldwide. People can now order McDonald's even if they're unable to go there physically. They can have the food delivered. And that's going to be a big advantage for McDonald's, especially because most of McDonald's locations are franchisees. So McDonald's Corporation doesn't own them, but McDonald's franchisees own these locations and operate these locations. If those locations require fewer people and people are ordering more on the app, and so McDonald's doesn't need to have additional cashiers or additional people at the drive-through window, that's more revenue per employee at McDonald's. And that makes each location easier to operate because you don't need to manage as many people. Managing people is the most difficult part of managing a McDonald's location. And these are people that are less senior, teenagers, or, the average age of a McDonald's employee is on the younger side. And so you have people with less work experience. They don't have the habits of showing up every day as you would like them to have. And so by having more automation, like ordering online and having the food delivered, that's helping the business. And then on top of that, there's more kiosks inside McDonald's locations, reducing the need for cashiers even further. So that's the big tailwinds driving McDonald's growth. And similar for Starbucks, the app has driven increased sales for Starbucks. But at the same time, the app has been something of a question mark. The founder and previous CEO Howard Schultz has complained about the app and online ordering, saying how that's disconnected Starbucks from its customers because it doesn't get to interact with the customers as frequently. And that had been a competitive advantage for Starbucks because it prided itself on treating its customers well, and the interior locations of Starbucks having people hang out and spend as it like a third place, right? You have your workplace, you have your home, and then they wanted Starbucks to be that third place. And with all the online ordering and to go ordering, that part of the Starbucks business model had diminished. So it'll be interesting to see what the incoming CEO does about that strategy shift. Comparing these two on profitability, McDonald's more than 3x the operating profit margin of Starbucks, but that's a result of the differing strategy. Starbucks locations, they're about 50-50 in terms of franchisee owned and Starbucks owned. And when when a corporation owns the locations, that decreases the profit margin, but it increases the overall profit because each location, the profit is coming all to the corporation. Whereas with the franchisee location, the profit margin is higher because the expense is almost zero and you have royalty revenues from each location. So you're taking, let's say, 3% of sales or 7% of sales, whatever the number might be. And that's almost all profit. That's almost all profit because there isn't the cost of goods associated. Whereas if you own the location, your revenues are higher, your expenses are also way higher, and then the actual profit number is way higher. And so you're dealing with larger numbers and smaller percentage margins. That's the big reason for this big difference here in terms of Starbucks profit margins and McDonald's profit margins. That being said, the profit margins for Starbucks are more under pressure because of declining sales and the struggles, the near term headwinds, whereas McDonald's has more momentum in increasing the profit margin. And given those tech improvements I highlighted earlier, the food delivery side of the business and the kiosk side of the business, reducing the need for employees on each location, will likely encourage franchisees to want to open more locations, which could lift the business's profitability overall. And of course, system-wide sales are increasing because people are ordering McDonald's more often now because they can have McDonald's delivered to them instead of having to go to the location when they want McDonald's. So that's the tailwind there for McDonald's. Before I compare the price to earnings ratio, I want you to understand why I'm using the price to earnings ratio. The price to earnings ratio is an important financial metric I use to determine which stock is more expensive or if a stock is too expensive. Let me show you this example here. I have two stocks, one trading at a market price of $100 and one trading at a market price of $12. The one trading at a market price of $100 has an earnings per share of $2.58, while the other has an earnings per share of just 11 cents. When we look at their price to earnings ratio, the one trading at a market price of 100 is trading at a price to earnings of 38.76, while the one trading at a market price of $12 is trading at a price to earnings of 114. So in this example, the one trading at a market price of 12 is actually more expensive because I'm paying 114 times earnings to purchase this stock. That means if the company was to pay me earnings per share every year as a dividend, it would take 114 years for me to receive my money back. Whereas the other stock, it would pay me back in 38.76 years. Now, there's a lot more to think about in this equation, but to simplify, that's an example that shows you why a company with a market price higher can actually be cheaper than a company with a market price that's lower. So now that you see the importance, let's look at the comparison. Starbucks trading at a forward PE of 26 and McDonald's at a forward PE of 24. So based on everything we looked at, it's a close decision here, but I think longer term Starbucks has better growth prospects than McDonald's. And for that reason, if I was picking between these two, I would pick Starbucks as the better stock to buy. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.